October 17, 1931. Tax justice. A federal jury convicted Alphonse Al Capone on 5 counts of income tax evasion. In that trial, the prosecutors produced evidence that Capone had willfully evaded taxes on income he earned illegally over several years, and that he had failed to file returns for some years. The jury delivered a guilty verdict after deliberating for approximately 8 hours. 6 days later, Judge James H. Wilkerson sentenced Capone to 11 years in federal prison, along with a fine of $50,000 and a liability for back taxes of $215,000 plus interest. The sentence also included court costs. Capone's conviction marked a landmark moment in federal criminal enforcement, highlighting the capacity of the U.S. government to use tax law to target organized crime. The legal basis for charging Capone with tax evasion derived in part from the precedent set in United States v. Sullivan, 1927, in which the U.S. Supreme Court held that illegal income could be taxed, and that the Fifth Amendment did not bar an obligation to file returns even for illicit earnings. This principle enabled prosecutors to frame Capone's failure to report income as a federal offense regardless of the illegality of its source. The case also embodied a strategic shift in federal enforcement. Rather than rely exclusively on prohibition, bootlegging, violence, or racketeering charges, which often faced obstacles from witness intimidation, corruption, or lack of direct evidence, authorities turned to financial records and accounting trails as a means to hold major criminal figures accountable. Capone's indictment in June 1931 covered income from 1925 through 1929, and the government asserted that he had evaded taxes totaling $215,000. He was initially offered a plea deal of 2.5 years if he would plead guilty to both tax and prohibition charges, but Judge Wilkerson rejected that agreement. Capone subsequently entered a not guilty plea, and the government chose to drop the prohibition charges at trial, concentrating on the tax counts. The evidence presented at trial included ledgers and admissions made during pre-trial negotiations that his counsel had offered to pay taxes on income that Capone had previously failed to report. The prosecution also emphasized his lavish spending, arguing that his expenditures outstripped legitimate sources of income. The conviction of Capone had profound consequences for the fight against organized crime. It marked one of the first times that a major criminal boss was removed from power through financial prosecution rather than through violent confrontation. Capone's downfall sent a message that even in environments where violence, corruption, and intimidation dominated, federal authorities could still reach criminal figures through fiscal means. Once imprisoned, Capone lost direct control over the Chicago outfit, and his underlings, including Frank Nitti, faced increased federal scrutiny. The case also encouraged federal and Treasury investigators to expand their use of ledger analysis, forensic accounting, and financial subpoenas in other investigations of organized crime. Moreover, the Capone conviction influenced public perception and policy. To many Americans, it represented the triumph of law over brute force, showcasing that the federal government could subdue powerful criminals through rule-bound enforcement. The case bolstered public confidence in institutions like the Internal Revenue Service and the Department of Justice. In political terms, it strengthened the role of financial oversight tools in the federal arsenal against crime. In subsequent decades, prosecutors and agents increasingly incorporated tax charges into their strategies against mob figures, drug traffickers, and corrupt officials. The logic that illicit income is taxable income became part of standard prosecutorial doctrine. From a historical viewpoint, the conviction on October 17, 1931, marks a turning point in federal crime-fighting strategy. It showed that robust enforcement did not always depend on force or violence, but could depend on paper trails, audits, and judicial resolve. It helped shift the balance in federal-local power, as the national government demonstrated that it could disrupt local crime syndicates that operated under the shield of corruption. In the long term, Capone's conviction signaled that organized crime would henceforth be vulnerable not just to violence or police raids, but to financial scrutiny and enforcement of tax law. For enthusiasts of historical ephemera, visit history-collectors.com to find collectibles that might complement your collection. You can own a piece of history.